Let's play a quick game. You inherit $50,000 cash. No debt attached to it. No strings. It's sitting in your account today. What do you actually do with it? Comment A if you leave it in savings. Comment B if you put it in the stock market. Or maybe comment C if you do something else entirely. I want your honest answer, not the smart sounding one. Here's what I noticed after asking people this question. Almost everyone say either A or B. Leave it safe or chase the growth. Those feel like the only two lanes that exist. I get why. Because nobody sits you down and shows you a third lane. Banks don't advertise it. Most advisors don't bring it up because it usually is not a product on their approved shelf. My wife Lorena and I have been investing in real estate since 2006. And for years, we only knew the two lanes. Rental properties or the market. It wasn't until we started buying mortgage notes directly that we realized there was a seat at this table that nobody had shown us. The bank seat. Let's walk through what actually happens when A or B, because the math matters. If you put $50,000 in a savings account, even a strong one, you're earning somewhere around 4% if you're lucky right now. That's about $2,000 a year before tax. Option B, the market historically averages higher over long stretches, but it's not a straight line. You could be up one year and down 20% the next, right when you might actually need the money. If you just inherit the cash and want to feel steady, that swing is a real cost, even when the long-term chart looks fine. Here's the third door. Instead of putting your money in the bank or into the market, you put it into the exact seat the bank sits in. When a bank lends someone money to buy a house, that loan becomes a mortgage note. It's a real tradable asset. Individual investors, like you and me, can buy those notes directly and step into the lender's position. You don't own the house, you own the loan. The homeowner makes their payment every month, backed by a first-lien position on the property, and that payment comes to you instead of the bank. No tenants, no repairs, no 2 a.m. phone calls. You're not managing a property. You're collecting on a contract. Why would a bank or lender even sell that? A few reasons. They need liquidity now instead of collecting slowly over 30 years. They're rebalancing a loan portfolio. Or the loan doesn't fit the internal risk model anymore, even though the borrower is paying on time. None of those reasons have anything to do with whether the note is a good asset. They have to do it with the seller's needs, not the note quality. And that gap is where investors step in. Let me show you what $50,000 actually buys in this world using real illustrative numbers. A homeowner has a note with a $54,000 unpaid balance, 7% interest, payment schedule already established, years on-time payments behind it. That note might trade at a discount, somewhere around $50,000, because the current note holder wants the capital back now instead of collecting it slowly over the life of the loan. You step in, buy the note at a discount, and start collecting that same monthly payment that the previous holder was collecting. That's roughly a 7% illustrative yield on your $50,000, secured by real property. Not by a hunch. Before any of that happens, you or someone guiding you checks the fundamentals. Loan to value, so you know the collateral actually covers the position. Payment history, so you know the borrower is reliable. And the paperwork, so you know that your lien position is exactly what it's supposed to be. I want to be straight with you. These numbers are illustrative, not a promise. Every deal is different. Every yield depends on the specifics of that note. And you should check with your own financial advisor before making any investment decision. But here's the actual point of this video. A and B aren't your only two lanes. There's a third door that most people never get shown. And it's the same seat the banks and institutions have used for generations. I'm Mario, the co-founder of Ritual Notes, with my wife Lorinda, and this is exactly what we walk through in the free 5-day Become the Bank Challenge. 5 short videos, 1 a day, no pitch, no obligation, just a clear look at how this actually works. If you go through it and it feels right for you, you can always book a call and we'll talk through your specific situation. So back to the question, $50,000, no debt, what would you actually do with it? Drop your honest answer below, A, B or C. I read everyone.